Hi, I'm Jonathan Wild. In this video, we cover how to record adjusting entries for prepaid expenses and unearned revenues. The reason we do adjusting entries is because we use something called accrual accounting, which means we record revenues when services and products are delivered and record expenses when incurred. I know. It's a cruel world. This is different from cash basis accounting, where we just record transactions when cash is received or paid. Let's run through some examples using accrual accounting. So a company purchases a 12-month insurance policy on December 1st by prepaying $1,200 cash. To record this entry, we debit prepaid insurance for $1,200 and credit cash for $1,200. We debit prepaid insurance to increase that prepaid asset. Now, let's fast forward to the end of the accounting period, December 31st. And now this is where the accrual accounting comes in. So by December 31st, 1 month of our 12-month insurance policy has expired. Therefore, we need to record the expense of 1 month of insurance. To do this, we take the $1,200 cost and multiply it by 1 over 12 months. This gives us insurance expense of $100. To record this entry, we debit insurance expense for $100 and credit prepaid insurance for $100. We credit prepaid insurance to reduce that prepaid asset account because now 1 month of that insurance has expired. Let's do another prepaid asset example. This time the company purchased $5,000 of supplies on credit during the month of December. To record this transaction, we debit supplies for $5,000 and credit accounts payable for $5,000. Now, fast forward to December 31st, and we physically count that we have only $4,100 of supplies left. This means that we have now used up $900 worth of supplies. And because we use those supplies, we must record an adjusting entry on December 31st to recognize that expense. So we record a debit to supplies expense for $900 and a credit to supplies for $900. We record the $900 credit to supplies to reduce that asset account down to $4,100. Let's do another example, this time for something called depreciation. When a company purchases a plant asset, like a building, a machine, or a piece of equipment, they probably expect it to last for a while. However, these plant assets wear down over time. Depreciation allocates the cost of these assets over their expected useful lives. Now, I think this will make more sense when we do a problem. So let's assume a business purchases equipment for $12,000 cash on December 1st and expects it to have a useful life of 2 years or 24 months. At the end of the 2 years, we expect the equipment to be worthless and have zero salvage value. To record the purchase on December 1st, we debit equipment for $12,000 and credit cash for $12,000. Now, fast forward to December 31st, and we have to record an adjusting entry for depreciation. To compute depreciation for the month of December, we take the $12,000 purchase price, subtract the estimated salvage value, which in this case is 0, and times it by 1 month over the 24-month useful life. This gives us depreciation expense of $500 for the month of December. To record this adjusting entry, we debit depreciation expense for $500 and credit accumulated depreciation on equipment for $500. Accumulated depreciation is a contra account, meaning it reduces the account it is linked to. In this instance, accumulated depreciation is linked to equipment, and it will reduce the amount reported for equipment. So, when equipment is reported on the balance sheet, we will see the original cost of $12,000 less the $500 accumulated depreciation for a book value of $11,500. Now I want to shift away from talking about prepaid expenses and depreciation and talk about unearned or deferred revenue. Unearned revenue is cash received in advance of providing products or services. In return, we promise to provide these products or services at a later date. So let's assume a company receives $10,000 cash in advance from a customer in early December. In return, the company agrees to provide 5 months of advisory services to the customer. To record the initial entry, we debit cash for $10,000 and credit unearned advisory revenue for $10,000. Unearned advisory revenue is a liability account because we now have an obligation to provide services in the future. Fast forward to December 31st, and the company has now provided 1 of the 5 months of advisory services. Therefore, we have to record an adjusting entry to recognize the revenue we have now earned. To compute revenue earned, we take the initial $10,000 and multiply it by 1 over 5 months. This gives us $2,000 of revenue. To record the adjusting entry, we debit unearned advisory revenue for $2,000 and credit advisory revenue for $2,000.